I'm a pretty good seller myself. Perhaps that's because I've been around so long and given so much back over time. I would say to the gentleman that I am going to be selling my gold stocks when the reasons that I own them have passed. I own them because I think that the US dollar, and in particular, US dollar denominated savings instruments, are at some risk. One risk is debt and deficits. The on-balance sheet liabilities of the U.S. government exceed $32 trillion. The off-balance sheet liabilities of the U.S. government exceed $100 trillion. And we service this debt with a budget that's in deficit $2 trillion a year. So the first circumstances that would cause me to sell my gold stocks would be a balanced budget. I look forward to that. The second reason that I own the gold stocks, in addition to the credit quality of the issuer, is that U.S. dollar denominated savings products offer a negative real yield. The U.S. 10-year Treasury offers to pay you 3.5% a year to lend them money for 10 years in a currency that the Congressional Budget Office suggests is losing purchasing power at between 7 and 7.5% compounded. In other words, the value proposition of the U.S. 10-year Treasury is that the government will cost you 3.5% of your purchasing power every year for 10 years, return-free risk. If we had a return to positive real interest rates, which is to say, if the interest yield on the U.S. 10-year Treasury was in excess of the rate of inflation, I would consider selling my gold stocks. The third reason is the value proposition offered up by long bonds, part of which we just discussed arithmetically. The biggest institutional investors in the world typically have 60% of their portfolio in bonds, which is presenting a problem for them. As interest rates go up, the capitalized value of their distributions, which is to say the bond principal, goes down. At the same time that the distributions from the bonds doesn't keep pace with inflation, which means that the obligation of the portfolio manager to provide for the benefit of pensioners, university students, things like that 20 years hence, gets attacked. The upshot of that is that after a 40-year bond bull market, I think that bond bull market is over. And I think we're going to see disintermediation in the long bonds in favor of other investment classes, including gold. The important thing to note there is that the market share of precious metals and precious metals securities in the U.S. market, the largest savings and investment market on the planet, is less than 0.5%. The 40-year mean market share of precious metals relative to other savings and investment assets is 2%. So gold doesn't have to win the war against the US dollar. It just needs to lose it less badly. If demand for precious metals and precious metal securities reverted to mean, it would lead to a 4-fold increase in demand for precious metals products in the US market. And that's precisely what I think is going to happen. Ergo, if the market share of precious metals and precious metals related assets reverted to mean, went up to 2%, I'd consider selling my gold stocks. Well, I've been in metals markets now for 50 years, and I would describe my relationship with silver personally as that of a beneficiary. Yes, silver has bored me sometimes, has disappointed me sometimes, but when silver has paid me, it has paid me so much and paid me so well that I remain attracted to it. If you look back at silver bull markets in history, the first one, of course, in my experience, was the 1970 to 1981 bull market. But the market, if my memory serves me correctly, went from $1.25 to $50. The second bull market I was prepared for. And in that bull market, the silver price went from $4, when people were disgusted with it, to $50. The third bull market was nowhere near as generous. The silver price went from $12 to about $50. My suspicion is that the stars are aligned for a precious metals bull market, which will, as we've talked about before, be led first by gold. But when the narrative is established, silver will move it, and silver will move it faster. Silver in my lifetime, as I say, has delivered 3 spectacular bull markets. I gave you the price action, but just to really whet people's appetite, I'm embarrassed to say, just to fire their greed. You'll recall in that first bull market, I said the silver price ran from $1.25 to $50. A then little-known penny stock, penny dreadful, a Spokane stock called Coeur d'Alene Mines, ran from 10 cents to $65. But the second bull market, I financed 2 little tiny silver companies, one called Silver Standard Resources, my friend Bob Porterman. That went from 72 cents with a full warrant all the way to the mid-40s. That's dollars, not pennies. The second one was Pan American Silver with my friend Ross Beatty, which went from 50 cents to $40. The upside in silver, but more importantly, the upside in the silver stocks, is unbelievable. My friend Doug Casey, many of your listeners will be familiar with, once at one of my physical conferences suggested to the audience the combined market capitalization of all the silver companies, including the silver pretenders, the fake silver companies, was so small that when the precious metals narrative went to the generalist investor, and the generalist investor tried to crowd in the silver space, that the market capitalizations of the silver companies couldn't handle the money that came in. He described the result as trying to siphon Hoover Dam through a garden hose. It's important when one considers coal as an investor to divorce the arithmetic from the narrative. The narrative is that coal is going the way of the dodo bird. The truth is that the largest year on record for coal demand was 2022. As you and I speak, there are 160 coal-fired plants under construction worldwide, Greta notwithstanding. I'm not going to defend the morality of owning a coal mine. I'm not going to suggest that they don't lend to water pollution. I'm not going to suggest that they don't lend themselves to air pollution. What I am trying to say is that 1 billion people on Earth have no access to electricity. Another 2 billion people on Earth only have access to unaffordable or intermittent electricity. Those people are in societies that haven't contributed a lot historically, global carbon loadings. And they are societies that on a per capita basis generate a lot less carbon than we do. The idea that they're going to stand still and be lectured by us, given our lifestyle, and asked to deprive themselves of their lifestyle without us going first, probably very, very, very low. I don't know if you do this, but I correspond fairly frequently with young people in emerging markets countries, particularly for me, students with Students for Liberty. They are not shy about remarking on the irony of 2,200 big thinkers taking private jets to Davos, being squired around in SUV limos, while telling them to conserve less electricity and drive less. I'm less bullish about lithium simply because everybody loves it. I don't think we have a lithium shortage. I think we have a shortage of refining capacity, processing capacity in lithium. So while I'm attracted to the big lithium producers, I'm afraid of the juniors, which is to say investing in juniors. The biggest risk is, of course, left of the right ear and to the right of the left ear. It's the analyst. Junior mining companies are risky. Most people don't have a tolerance for risk. They're also volatile. Most people don't have a tolerance for volatility. But importantly, they require lots of work. Most investors don't want to put in the work. I tell people who care what I think that the number of junior mining stocks that you own should correspond with the number of hours per month that you're willing to spend understanding them. If you're willing to spend 10 hours per month, then you can own 10 stocks. I think in a very general sense, if there's 2,000 or 2,500 junior miners in the world, there's probably 150 or 200 that are viable. You have to be willing to separate the wheat from the chaff, and you have to be willing to own an asset class that can fall by 10% in a day. The people who can talk about that, particularly in a bull market, are numerous. The people who can do it in real